Great, it's 8:20. I think we should begin. Good morning once again. Karibu sana to this webinar once again. We appreciate your time, as always, for joining us to go through the various topics that we prepare for you month on month. So we're really happy that you could join us this morning as well. Thank you. My name is Doreen Adoj. I'm the Client Relationships Manager here at the firm, and happy to be able to host you this morning. Feel very welcome. We have prepared various insights into the Tax Appeals Tribunal decisions, which will be handled by my colleagues. A very interesting team this morning as well, and they will introduce themselves as they take us through the various sections that they have prepared. So without much wasting of any more time, I will invite them to be able to take us through their content. They will introduce themselves as they come along, starting with Jedida, who will come on first. Just a reminder, please keep your microphones muted through the discussions, but you can use the chat function to put down any questions or comments that you may have as we go along, and we'll be able to tackle those as we go along. As usual, you can also raise your hand during the question and answer time. But for now, please feel welcome as we discuss emerging trends in the Kenyan tax jurisprudence, which is a review of the Tax Appeals Tribunal decision. So karibu sana, Jedida.
Thank you much, Doreen, for that introduction. My name is Jedida Masharia. I am the finance officer here at the firm of Kiptines and Odhiambo Associates, and I will just run us through the first bit of our webinar today, which is the scope and review of our webinar, the key areas of focus in the recent tax decisions between the period January to March 2026. So the first bit of our webinar presentation today is going to be an introduction, and this is going to mainly be the tax assessments that we can receive from the KRA, which is our first initial point of contact with the commissioner. So what is a tax dispute? A tax dispute in Kenya is governed by the Tax Procedures Act and the Tax Appeals Tribunals and the relevant charging statutes therein. So the Tax Appeals Tribunal occupies a critical position in this framework because it is really the first independent adjudicative forum before which factual disputes, documentary evidence, accounting treatment, tax computation, statutory interpretation, and administrative conduct by the commissioner are tested. So we are going to delve into what are the kinds of tax assessments that we may receive as taxpayers. So the tax assessments are governed under the Tax Procedures Act, and they are mainly between the sections 28 to 31 of this act. So we mainly have 4 types of assessments under the Tax Procedures Act, which are the self-assessment, the default assessment, the advance assessment, and the amended or additional assessment. So I will take us through a tax assessment. So the self-assessment, which is the first type of assessment, is done by the taxpayer themselves in the prescribed form within a reporting year, and they're commonly known as tax returns. So the model under the success assessment, the taxpayer bears the primary responsibility for calculating, declaring, and paying their tax liabilities. So under the tax assessment, this is where we get returns such as the VAT return, the payee return, and the income tax return that is typically done at the end of the year. Then the next type of assessment is a default assessment. So this is an assessment that is done by the commissioner based on information that is available to them when a taxpayer fails to submit a self-assessment. So this default assessment will often be based on third-party information such as iTax records, withholding tax information, any customs data through the ICMS platform, bank information, supplier declarations, VAT inconsistencies, ETIMS data, or any other information that is available to the KRA. Then the next type of assessment will be the advance assessment. So this is done by the commissioner, but before the due date of the submission of the tax returns. So it's key for us to understand that a default assessment is done by the commissioner after the close of the submission period if a taxpayer fails to file their tax returns. However, an advance assessment is done before the due date of the submission of these tax returns. And an advance assessment allows the commissioner to protect the revenue in circumstances where they justify early assessment, particularly where there is concern that tax may become difficult to collect if the commissioner waits until the normal filing date. Then the final type of assessment that we are going to look at is an additional assessment. So this kind of assessment is done by the commissioner to an original self-assessment return done by the taxpayer. And an amendment assessment is particularly common after audits, compliance checks, data matching exercises, sector reviews, or investigations. So I will just give like a brief, I'll just invite my colleague Rosemary, who will take us through the life cycle of a tax dispute in Kenya, and she will also run us through the key things that we find out, the key trends that we found in the decisions of the Tax Appeals Tribunal. Thank you.
Good morning, everyone. I am not Rosemary. My name is Victor Chava. I'm an associate in the firm. It's a pleasure to be here today. I'm stepping in for Rosemary, and I will just start off by looking at the life cycle of a tax dispute. As you know, a tax dispute, it doesn't primarily begin at the point where you're appearing before the tribunal or you're in court. It starts way early, and it starts from the point of the tax assessment. So this is the point where the taxpayer's liability has been determined or has been asserted. Through, it can be a self-assessment or the different modes of assessment as Jedida has just highlighted to us. And then at the point of that assessment, it's important to just know different tax heads or that a taxpayer would be required to report on to be able to just review that whatever they have reported is correct. Because if it's not correct, then and a review is done, then you probably now have the amendment assessment or additional assessment coming in, where either the commissioner would be of the opinion that what has been presented or what has been asserted as due is not correctly reported. So at that point, when then an additional assessment is given, then we come to the next step, where if you have an objection, then you can file a notice of objection. This is where you disagree with the findings of the assessment or you intend to oppose the decision. So what you usually do is you file a notice of objection within a given statutory timeline, and we see it's within 30 days of the notification of that decision. So you have to be very careful that, as you will see later on, why it's very important to be very critical of the different timelines. So the notice of objection is a very critical stage because the objection frames the dispute. So ideally, it is where the taxpayer will first formally challenge the commissioner's position. So it is also where the taxpayer begins placing evidence before the KRA insofar as objecting to the assessment that has been issued. So, and then after the notice of objection has been filed, and we move to the third stage, which is where we have the commissioner's review and objection decision. So after receiving a valid objection, the commissioner will then review the taxpayer's grounds, the documents that you'd have provided, the explanations that you would have provided. The commissioner might actually even request for additional information, and the taxpayer must also respond to that request within 7 days actually. You have, if the commissioner asks for additional information, again, you have to provide that information because it is what will inform the decision of the commissioner. So the commissioner will then consider the objection and then they will issue a decision. So the objection decision may allow the objection in full, or in part or disallow. That means the commissioner might agree and side with the taxpayer so far as objection is concerned and say that it is merited. They may allow it partially so that they now vary the assessment, or they might even now disallow it completely, meaning they will side with the position of the hearing. So importantly, the commissioner is expected to give reasons for the decision and address the material facts and issues that have been raised by the taxpayer, so the decision will critically be informative in how the commissioner has arrived to the decision that they have taken. So that point now, depending on the outcome, so if, of course, the commissioner sides with the taxpayer, then the dispute will end at that point. If it's partial, then it depends. Again, if you're dissatisfied or if it's disallowed, then you're able to appeal, which is the next fourth stage. And this appeal is to the Tax Appeals Tribunal. So and this is where now the taxpayer is dissatisfied with the objection decision by the commissioner. So what happens is they will then now file the appeal at the Tax Appeals Tribunal. This is the first independent adjudicative body in tax disputes and tax processes, and it derives its mandate from the Tax Appeals Tribunal Act. So at this stage, again, what is considered is both factual and legal issues. So this makes the tribunal stage particularly important because it is where the taxpayer has an opportunity now present its documents, its factual evidence, tax computations, any reconciliation, but also support them with legal arguments to try and bring in a better understanding of why a varied decision should be issued as opposed to what the commissioner or the taxman had initially issued. So as I indicated, there are procedures that are laid out in the Tax Appeals Tribunals Act, and this includes the filing of a notice of appeal, and then you have the subsequent filings, your filing of memorandum, your statement of facts, of the tax decision being, or rather the decision of the commissioner that you're actually appealing against. So, and as we'll see in the procedural compliance becomes very critical. The provision of this documentation again becomes also very critical in informing the kind of decision that the tribunal will take. So once you have the appeal filed and lodged at the tribunal will then take a decision, and the decision will be taken after a hearing of the parties. So the tribunal will invite the taxpayer, will invite the commissioner for them to each make their presentations and arguments. So before they can then take a decision. Again, the decision that the tribunal will take is they will either allow the appeal or disallow the appeal. Yeah, so the good thing with the tribunal is that it will look at both questions of fact and question. Therefore, the taxpayer really has quite the onus, and as we'll see later on, to really provide as much documentation, as much proof to this. And then once a decision has been taken, again, if the taxpayer is still dissatisfied or the commissioner does not agree then with the position that the tribunal has taken, then they then proceed to the High Court, which is the next stage. So the appeal to the High Court is usually where one is dissatisfied with the decision of the tribunal, basically. So, but the nature of appeal in this particular stage is usually just concerned with questions of law. So it does not ordinarily hear the entire factual dispute or reconsider all the documents afresh. So it will only limit itself to particular questions of law. So I think that a very important distinction to know that where you can provide as much evidence, as much factual evidence is at the tribunal stage, because once you fail at the tribunal stage and the appeal goes to the High Court stage, then the High Court will limit itself to questions of law. So I think, and what ideally the High Court will be asking itself is whether the tribunal properly interpreted the applied the correct legal principles, acted within jurisdiction, was there procedure, fair administrative action, a decision that was taken by the tribunal. So those are the issues that High Court will consider or take into account when listening to that appeal. And then the final stage of the appeal will be at the Court of Appeal. Again, if dissatisfied with the High Court's decision, one might appeal again to the Court of Appeal, again, generally on questions of law. And at this point, the dispute, is further removed from the factual or evidentiary issues that may have dominated the assessment at the lower stages. So again, the Court of Appeal just focuses on very critical law. So ideally, that will be the life cycle of a tax dispute, not merely a sequence or procedural of steps, but rather a way of one knowing how to best manage their risk frameworks, at which stage they need to produce what and where they might best defend their case. So I think critically, it's just important for one to understand, and as we'll see, what is involved across the different stages of the tax dispute, right? So we'll then now move to the emerging trends. That we have seen from the decisions that have been taken by the tribunal. And the first one is procedural compliance. There have been very strict treatment of procedural compliance, particularly by the tribunal. And so you'll realize that now in tax disputes, procedure is not an issue. Procedure then becomes something that will actually speak to jurisdiction, which is like the foundational question. The tribunal will ask itself whether it has jurisdiction, and how it will come to that conclusion is by looking at, what procedure is laid down and whether that procedure had actually been followed. And then before the tribunal can actually consider whether an assessment is excessive or whether the law was misapplied by the commissioner in the decision that they took, before even a substantive defense can be mounted by the taxpayer, one has to properly demonstrate that they are properly before the tribunal in terms of when did they file notice of appeal, when was the memorandum of appeal filed. Those timelines are very critical. Now, I think important to look at is some of the cases which inform, this very strict adherence to procedure. And the first one is the case of Barrick Enterprises Limited, Commissioner of Domestic Taxes. In this case, the taxpayer challenged the VAT assessments relating to, alleged under-declared sales. And the commissioner did the assessment and raised an objection relating to that objection challenging actually a competence of the appeal card file, and the basis of that was section 13 of the Tax Appeals Tribunals Act. So ideally, by failing to attach the decision for which they were appealing, which can be considered as a procedural issue, the appeal in itself at the tribunal actually failed on that basis. So the tribunal held that the appealable decision is a mandatory jurisdictional document, and that the failure to attach it actually deprived the tribunal of the proper basis to exercise appellate jurisdiction. So effectively, by the taxpayer failing to follow the procedure in terms of what needs to be provided for the appeal to proceed, they failed to attach one critical document, the decision of the commissioner, and because of that, then the appeal failed. So I think the significance of the Barrick decision, can be understood, I think, in three aspects. First is that the decision confirms that statutory filing requirements, especially in tax appeals, are not mere technicalities. They actually go to the essence of what the tribunal will look at for you to declare or vest itself with the appropriate jurisdiction to hear the matter. So as a matter of just, placing the significance of why we really need to be very careful in looking at the tribunal. Now, the second issue that this particular case brings out is the second issue is the significance that the tribunal gives when it comes to adherence to procedure in terms of timelines. When
we apologize for that interruption. Perhaps just trying to get Chama to switch off his video. We see if that could improve the bandwidth, then we'll be proceeding in a very short minute. Again, apologies for that interruption. Chama, could you just try again? If you can hear me. Very well. As we wait for Chama to resolve that, allow us then to just quickly scan across over to two principal questions that, of course, came out of the Tax Appeals Tribunal's decisions. And then one of them, of course, critically was rolled over to the High Court that we're going to talk about shortly. And that is on one, how to treat debts, bad debts, that is, principal, loans, and circulating capital. Of course, this will affect a great deal those of us in the financial services sector, where from principal earning comes from the loans that are advanced out there. The capital comes back into the business, is circulated, and that keeps the business a going concern. So, of course, what we consider a good decision came out of the Tax Appeals Tribunal. We will talk about that shortly. Second, which I think we're also fairly excited about, is the Tax Appeals Tribunal's decision on excess duty, particularly when it comes to the treatment of interest income on excess duty. Again, this touches those of us who are in the financial services sector, where capital investment is what is principally used to generate revenue for the business. Of course, these, as we say, of course, are decisions from the Tax Appeals Tribunal, which is what we continue monitoring. We, of course, still want to give the rider that these are not final positions. Of course, with respect to bad debts, principal loans, and circulating capital, this was already decided at the High Court level, so fairly advanced. We do not expect that the Court of Appeal will deviate. Should it go, of course, should the Commissioner elect to go to the Court of Appeal, will deviate largely from that particular question. So, of course, we'll continue monitoring that and give you guidance should there be any material change at the Court of Appeal level. Of course, with respect to excess duty, that also is a fairly recent decision. The High Court may take a different view. And then, of course, when it goes further along, certain changes may come. Of course, together with that is the indication that unlike many other decisions that go through our typical court channels, what runs across from the commissioner, then across the Tax Appeals Tribunal, through to the court, through to the High Court and the Court of Appeal, as Chamba was running us through that life cycle of tax disputes, ordinarily becomes law almost overnight, in the sense that that then becomes the operating position that the commissioner will be treating you as a business. So of course, that forms the basis upon which we reckon that we want to continue monitoring the decisions that flow from the Tax Appeals Tribunal, because the next day, literally, as you relate to the Revenue Authority, you will need to have this top of mind, that there has been a significant change either to your benefit or making perhaps the regulation of tax fairly stringent. So with that, let us start with the question of excess duty, because that was fairly straightforward. Of course, this was a prime bank dispute with the commissioner, and the Tax Appeals Tribunal came out with quite some degree of clarity on how to treat excess duty with respect to financial transactions. And three critical things came out, which we just ran through very quickly. Of course, top of the list, number one, is that interest income is expressly non-excisable. Of course, we do know that every time we have the finance bill, there's a significant change in different tax heads. Then down the road, the Excess Duty Act will ordinarily be reviewed every so often, because it's an instant source of funds for government. So a constant review of the Excess Duty Act often will yield either increase, reduction, or bracketing of things that ordinarily were not within the purview of excess duty into regulation under excess duty. And of course, you'll remember the year 2023 running into 24 and 25, there had been significant discussions on interest income and whether or not they're excisable. Of course, the commissioner had taken the decision that in fact interest income is excisable, because this is, whereas it's a consumer tax, it is remitted at the point of the service provider, or if it's whether or not a consumer tax, remitted at the point of the goods provider. So of course, interest income was banded in there. But when Prime Bank raised this issue, of course, for the benefit of many in the banking sector, there were a lot of interested parties in the matter. The TAT came out strongly giving the indication that interest income is not excisable. That being said, however, any fees and or commissions that are charged in the process of non-interest fees and commissions in the banking or the financial services sector definitely remain excisable. So it is not banding everything in terms of the interest income, but any fees that are charged over and above that interest income that is non-interest remains excisable. And then of course, third, which again gave a lot of clarity, because now you remember we have questions as to significant economic presence or services consumed in Kenya by a foreigner, or offered by a foreigner but consumed in Kenya, or vice versa. There was a question as to whether or not there is an excess duty tag on those services. And of course, the TAT came out giving the clear indication that services that are exported fall outside the excess duty regime. So that, I think, has given some significant clarity on that particular question. Of course, we will wait to monitor if the commissioner will want to go around this by a significant change in law to ban this for future implementation away from what the TAT, of course, has given an indication of. With that then, let's talk a little bit about bad debts, principal loans, and circulating capital, because this again was before the TAT. The matter there being Premier Credit Limited versus the Commissioner of Domestic Taxes. This is a 2026 decision. Then there were consolidated appeals in there, 80 and 89 before the High Court. And I think this went one way and then was reversed. And so it gave some fairly interesting determination. Of course, at the time, the TAT had taken a very strict accounting-based approach, where there was not a very strong distinction of principal and interest. And also, of course, the primary element in there that came from the TAT was that in any event where we have bad debts arising out of unrecovered principal sums, those were indeed treated as capital losses and therefore non-deductible. And so that, of course, had an implication, an instant implication on how you account for your taxes. But of course, the High Court came and gave a very liberal approach, perhaps if you could consider it so, and just perhaps to give a verbatim indication that the court held that the deductibility of bad debts depends on their relationship with the taxpayer's business operation. So the High Court took a business-oriented review where it distinguished. The TAT had taken a very strict review of saying it is non-deductible, it forms part of your capital, and your assessment shall be on that basis. That, of course, spoke to the fact that, because as we all understand, circulating capital ordinarily may suffer exposure. Say, for instance, you've put in your money somewhere, there has been a significant change in the economic condition. What it was at the point that you put it in is not what it is at the time that you're trading with it. So perhaps you want to provide for certain capital losses. The TAT had taken a very strict approach on that particular issue. But then we see the High Court in the consolidated appeals taking a more business-oriented functional approach in reviewing capital losses, bad debts, and of course, whether or not you can claim that as a deductible element when accounting for your tax or not. And so the High Court then says that the deductibility of bad debts depends on the relationship with the taxpayer's business operations. Of course, that then flows into two principal issues. Number one, where the loan forms part of the taxpayer's ordinary income generating activities and constitutes the circulating capital or stock in trade, losses arising from non-recovery then qualifies as a deductible revenue loss. But then, of course, in the converse, if you are merely a victim of the ebbs and flow in economy, then particularly for things like enduring capital, you cannot claim that as a deductible loss, because then you are being, for lack of a better word, unfair to the revenue authority. So that is the critical distinction that the High Court brought in there. With that, let me send it back to Chama to then talk us through other decisions that came from the TAT, and of course, perhaps flowing over to the High Court. Chama, you can try now.
Thank you, Brian. Can you confirm you can hear me better now?
That's better. That's better.
All right. Yeah, so we were just talking about the Barry case in so far as procedure is concerned, and I just highlighted the critical importance that the tribunal places on following of procedure. I'll just invite my colleague Rosemary to just make some additional comments before we proceed.
Thank you, Chairman Brian and Jedida, for taking us through thus far. My name is Rosemary. I'm a partner within the firm in the tax practice. Flowing from the procedural compliance, which Chama has taken us through in terms of the life cycle of a tax assessment to the point of appeal, all the way to the Court of Appeal should a taxpayer or the commissioner want to challenge a particular stance that has been taken by the court. You would notice that timelines tend to be very strict in relation to tax processes because they have a bearing on jurisdiction. And that's what we get from the Great Heights Venture versus Commissioner case. And what is even more important is the trend on the issue of burden of proof. You will notice for any litigator on the call, we all know that he who alleges must prove. But in tax, it is upon the taxpayer to prove that a particular assessment that has been made is incorrect. And that is based on Section 56 of the TPA Act. There is currently a petition that was filed by Dr. Magare, which seeks to change that. It's still ongoing as per the last observation on CTS. I think it has a date for June. It would be interesting to see how the courts determine that that petition. For those interested, it is High Court Constitutional Human Rights Petition number E002 of 2026, Dr. Magare petition. That is how I like to frame it. It would be interesting to see whether the courts would have a different stance as to the placement of the burden of proof, or if, depending on the decision the courts take, there is a likelihood that Kerry and Co is likely to amend the law to make it more of a shared burden as opposed to a single-sided burden, which seems to be the issue for the litigators in court. But for purposes of tax, that is essentially it, that the burden of proof is upon the taxpayer. And how is this burden of proof satisfied? It is through the provision of documentary proof. You will notice in the life cycle, once an assessment has been made against a taxpayer and the taxpayer is unhappy with it, an objection must be lodged through the iTax platform. And according to the provisions of the law, that as you lodge your objection, you must also submit every documentation you wish to rely upon. So if you do not have sufficient documentation, then the decision would be against the taxpayer. And that is what we actually find in the Rafiki microfinance case, where they had essentially stated that they had to render some of the debt as bad debt on account of defaulted loans. However, they failed to actually provide those documentations to show what is the bad loan, what is default loan, what part of the principal is left unpaid, and what part of the interest is left unpaid. So essentially, out of this, then we see that the issue of burden of proof really lies on the taxpayer as per the Tax Procedures Act. Now, from all these trends, we have talked about the procedural irregularity aspect. We've talked about documentation and burden of proof. We've talked about excise duty. We've also talked about the principal loan versus interest and bad debt, and what is that impact on any business and taxpayer. If we can move to the very second last slide. So the impact means that every taxpayer must make sure they comply strictly to the provisions of the Tax Procedures Act and any other tax law required. Timelines are essential. Out of it then means you increase the exposure to your books, and a tax assessment would be taken against you, and should you challenge, the tribunal would still find it against you. So in actual sense, there must be a strict approach to procedural compliance. There's also the increasing emphasis on documentation. A while back, there was the discussion as to whether challenges on a tax assessment should be left for accountants or lawyers should take up that approach. My view is that accountants, given that they know the books better than we lawyers do, should in fact participate in these processes as expert witnesses, given that the procedure before the tribunal and courts is legal in nature, where fact and law comes into play, that it's in fact the lawyers who should take on that baton of defending the taxpayer. But an accountant's role should also still be appreciated in the form of being an expert witness, because they're more likely to testify as to the numbers, and the lawyers are more focused on documentation. So a good balance between the accountancy profession and the legal profession would come in hand. And then the third impact is definitely the evolving approach as to what is a bad debt vis-a-vis the principal amount of the loan and interest. So if the loan ends up being in your ordinary course of business, it would be deemed as part of capital or stock in trade, and therefore you'd be in a position to deduct the same as an expense according to the High Court decision. But if it's not in your ordinary course of business, then you would have to consider it as either receivables. You're likely actually to just tag it as receivables, and then therefore the documentation route would have to take has to be made into consideration. Thank you. With that, then we would like to invite anyone on call with any question or comment in relation to the decisions taken or any trend that you have observed as well. Thank you.
Great. Thanks, Rosemary. I think perhaps as we wait for anyone who may have a question, clarification, or just want to also chip in, because I think this is a review more than it's not really knowledge sharing. It's a review of what we think is exciting from the TAT. Please also feel free to chip in. As Doreen did give an indication, the chat function also is available. Should you want to use that, please go ahead. And as we wait for that, we can just again run through very quickly what we went through in terms of some exciting things that has come from the TAT in recent past. Of course, top of the list was procedural compliance. We've understood that there's very strict adherence to that. There's a question of documentation and burden of proof. Rosemary has spoken about that very well. There's ongoing, of course, this litigation before the High Court as to whether or not that is tenable in Kenyan law. The Kizito Magari, Dr. Magari case, we'll keep monitoring that for you. Again, we spoke about principal loans, bad debts and circulating capital, how to treat those, what is allowable in terms of your accounting. And then we also did see something about excess duty, and particularly so when it comes to what is accessible in financial transactions generally. And then, of course, Rosemary has summed it up by just giving us a very quick run through of what impact that has on you as a business entity across your different tax life cycles. I'm seeing it's now top of the hour. We try to keep it within the hour. Again, we apologize for the delayed start. We're just trying to allow room for more people to join in. But other than that, we're happy to take any questions in the next 2 or so minutes. See that it's a quiet room. I'm also making the assumption that we're all comfortable. But nonetheless, should there be anyone, we can have a minute or so just waiting to see if anyone can pop up. Then we can hand it over to Doreen. Thank you.
Anyone with a question or comment? Anything to chip in to add? Chama, is that you? Did you have something to say? No. Right. Perhaps if there's really no question or comment, I think the presentation was very thorough and very clear. So maybe there might be no clarification sought. Thanks for the clap, Edwin, and thanks for joining us, everyone. Any comment you might have, and we also welcome any feedback on this webinar series that we usually present to you. If there are topics of interest that you would want us to be able to pay some attention to, we'll be happy to do that as well. And any feedback on the delivery, on the output, on anything that you would want us to maybe consider to improve on our webinars, we'd also be happy to take that feedback. But as usual, we're really happy to have you join us. Is there any question? Let me check the chat. Charlene, thank you for the wonderful session. Asante sana, Charlene, you're very kind. Kibe Mungai, good work from the presenters. Thank you for the comments. We appreciate you as well. Terry Modhoni, you have your hand up. Please proceed.
Yes, I would like to share my comments. I was just listening in, and there are so many insights that have been shared. And having not come from a legal background makes me want to find out more, to understand the context better. And I was just looking at your YouTube to just try and see whether you have uploaded these webinars there. And so that there's a lot of inactivity. It was years ago. My suggestion, could you please consider uploading your webinars there for someone who would want to revisit and maybe learn a thing or two from the webinars you've been sharing, maybe out of a need that has come out of business and maybe would want to understand much more. They can come there for reference. Thank you.
Thanks, Terry, for that comment. I agree with you. We will look into that and begin to upload those. We usually share the insights in form of a write-up, but that's also a really good idea, and we'll be able to do that. Asante. Any other comment or question? Right, so I guess we can assume that we're all comfortable, we're all okay, and maybe we can allow you to get on with your day. Cindy, do you have your hand up?
Yes, perhaps just a comment. This was very insightful, especially considering the fact that the tax sector is constantly evolving. So to have this platform or to have this firm just come across and give us updates on the tax sector, I think that was really good. So thank you so much.
Asante, Cindy, we appreciate. Caesar K, thanks for your comments as well. Thank you for the presentation, very insightful. We appreciate you all, and we thank you for your time, for joining us faithfully every month. We are grateful for that. We had initially prepared, invited you to a webinar on governance and compliance, which we unfortunately had to postponed due to unavoidable circumstances, but the same has now been rescheduled and will take place on the 26th of May. I will send out those invitations, but just note that down to join us for that webinar as well. It is this same month, so this month we'll have 2 of them. The last Tuesday of the month, please diarize that and plan to attend. Invite your teams, and we'll be happy to just progress with you. So thank you for your time, Moses. Thank you for the presentation. Please include us in future sessions. We definitely will. And with that, if there's nothing else, allow me to thank our facilitators. Jedida, thank you for your debut into this webinar series. Brian, Rosemary, and Victor Chama, asanteni sana for taking us through the session very ably. And to each of you for joining us, we appreciate your time. And I wish you a really lovely day ahead. If there are any follow-ups you need, just reach out to any of us or through the email that I used to send to invite you. So other than that, thank you for coming and have a lovely day. Asante.
Good day. Thank you.
Thank you. Good day.
Good day.